This is what happens when a 30-year-old MIT physics grad builds a $32 billion crypto empire in 3 years, then watches it collapse in 10 days. Sam Bankman-Fried went from being the 41st richest American with a net worth of $26.5 billion to federal inmate number 372445510, pulling off what prosecutors described as one of the largest financial frauds in U.S. history, an $8 billion theft hidden behind venture capital backing, celebrity endorsements, and the carefully calculated image of a disheveled genius who just wanted to save the world. Sam Bankman-Fried wasn't some dropout who stumbled into crypto wealth. MIT gave him a physics degree. Jane Street Capital gave him Wall Street credibility as a proprietary trader. And effective altruism gave him a philosophy: maximize your earnings specifically to give it all away. November 2017 brought the founding of Alameda Research, a cryptocurrency trading firm he launched in Berkeley, California, and the initial strategy was simple but profitable. Bitcoin arbitrage between Japan and the United States meant exploiting price differences across markets, and by 2018 they were moving up to $25 million per day. May 2019 brought FTX to life, a cryptocurrency derivatives exchange he launched with Gary Wang, his childhood friend from math camp. The timing couldn't have been better, with institutional money flooding the crypto market and FTX positioning itself as the sophisticated alternative to existing exchanges. 3 years later, FTX had become the third largest cryptocurrency exchange globally, claiming over 1 million users and operations across more than 130 countries. FTX didn't just raise money, they raised it from everyone who matters in venture capital. July 2021 changed everything with a $900 million Series B at an $18 billion valuation, and the investor list read like a who's who of sophisticated capital. SoftBank, Sequoia Capital, Coinbase Ventures, and more than 60 other firms. January 2022 brought the Series C, $400 million at a $32 billion valuation, and SoftBank Vision Fund doubled down while Temasek Holdings, Singapore's sovereign wealth fund, came in alongside Tiger Global, Lightspeed Venture Partners, and Paradigm. The total raised came to approximately $1.73 to $2 billion from 72 investors across 6 rounds. By March 2022, Sam Bankman-Fried's personal net worth hit $26.5 billion according to Forbes. 30 years old and ranked the 41st richest American. Most people assume Bankman-Fried's appearance was just how he naturally presented himself. That assumption was dead wrong. Caroline Ellison would later become CEO of Alameda Research and dated Bankman-Fried on and off. And when she testified under oath, she revealed that his messy hair, shorts, t-shirts, and general disheveled appearance were well calculated. The beanbag chairs he supposedly slept on for 4 hours a night, the $40 million Bahamas penthouse he shared with 10 roommates and employees, the vegan diet and unkempt hair, all of it was part of a persona designed to signal eccentric genius too focused on changing the world to care about appearances. And the strategy worked spectacularly. There's a documented instance of him playing League of Legends during a call with Sequoia Capital while they were evaluating an investment, and they still wrote him a check for $214 million. He pledged to give away most of his wealth. The FTX Foundation gave 1% of revenue to charity, and he appeared to be earning billions specifically to donate them. Reality check. Before bankruptcy, he'd only donated approximately 0.1% of his actual earnings. But the image of the altruistic billionaire was worth more than the actual donations. FTX's path to mainstream acceptance ran directly through sports and celebrity endorsements, and this wasn't accidental. It was a calculated legitimacy play. Tom Brady locked in $55 million for 20 hours of work per year over 3 years, paid mostly in FTX stock, while his wife at the time, Gisele Bündchen, received $18 to $19.8 million, also in equity. Stephen Curry got $35 million, and his ads literally claimed, "I'm not an expert, and I don't need to be. With FTX, I have everything I need to buy, sell, and trade crypto safely." Larry David took $10 million for a single 60-second Super Bowl commercial where the punchline was, "Don't be like Larry. Don't miss out on FTX." From a marketing perspective, this was brilliant. You're attaching your brand to the most trusted figures in sports, paying them in equity so they have skin in the game, and getting mainstream consumer exposure at scale. From a financial crime perspective, every dollar of those endorsements was funded with stolen customer deposits. Here's the technical architecture of the fraud, and understanding it explains why everything collapsed so quickly. FTX was supposed to be a neutral exchange where customer deposits stay in customer accounts, but Bankman-Fried owned approximately 90% of Alameda Research, and FTX owned about 90% of Alameda, which meant they were effectively the same entity under his control. He gave Alameda special privileges on the FTX platform, specifically the ability to borrow unlimited amounts, and what they were borrowing was customer deposits. FTX wasn't just facilitating trades, it was operating as Alameda's personal bank, funded by other people's money. Caroline Ellison became sole CEO of Alameda in August 2022, and she testified that Bankman-Fried demanded she create 7 different falsified balance sheets to hide what was happening. In September 2022, 2 months before the public collapse, engineer Nishad Singh testified that Bankman-Fried already knew there was a $13 billion hole in FTX's balance sheet. The bankruptcy filing revealed a hidden, poorly internally labeled fiat at account with negative $8 billion. That's $8 billion of customer funds that simply weren't there. Political donations ate up over $40 million to Democratic candidates in the 2022 midterms alone. Investments consumed $5.3 billion through FTX Ventures, deployed into 473 companies. Real estate took the $40 million Bahamas penthouse, and his parents received a home valued at over $32 million. But here's the structural flaw that made collapse inevitable. Alameda's balance sheet was heavily dependent on FTT tokens, FTX's own cryptocurrency. According to the November 2, 2022 CoinDesk article that triggered everything, Alameda held $3.66 billion in unlocked FTT and $2.16 billion in FTT collateral, which meant nearly $6 billion in a token that only had value because people believed in FTX. The whole system was a closed loop that only worked as long as nobody questioned it, and nobody tried to withdraw their money at scale. November 2, 2022 brought the CoinDesk article that published Alameda's balance sheet, and people who understand finance immediately saw the problem. The entire structure was built on FTT, which was essentially monopoly money backed by confidence. November 6th changed everything when Changpeng Zhao, CEO of Binance, FTX's largest competitor, announced on Twitter that Binance would liquidate all of its FTT holdings worth $580 million. FTT price started collapsing, which was the nightmare scenario because Alameda's entire balance sheet depended on FTT maintaining value. November 7th brought Bankman-Fried's tweet claiming FTX is fine, assets are fine, and he insisted on $1 billion plus in excess cash, while accusing a competitor of spreading false rumors. Caroline Ellison offered to buy all of Binance's FTT at $22 per token. CZ declined, and the token dropped 80%. November 8, 2022 arrived less than 24 hours after Bankman-Fried said, "Assets are fine," and FTX blocked all customer withdrawals, leaving hundreds of thousands of people without access to their funds. His net worth dropped 94% in a single day, from Bloomberg's estimate of $16 billion to $991.5 million, the largest one-day drop in Bloomberg Billionaires Index history. November 9th brought Binance's due diligence and immediate withdrawal from the deal. Caroline Ellison held a video conference with Alameda employees and admitted FTX used customer money to help Alameda meet liabilities. Bitcoin dropped 10% on the news, and Sequoia Capital wrote its entire $214 million investment down to zero within hours. November 11, 2022 brought the bankruptcy filing. FTX, FTX US, Alameda Research, and more than 100 affiliated entities filed for Chapter 11 bankruptcy, and Sam Bankman-Fried resigned as CEO. Bankman-Fried's net worth was now reported at zero, from $26.5 billion to nothing in less than a week. 10 days from the CoinDesk article to bankruptcy. That's how fast a fraud this large unravels once people start asking questions. December 12, 2022 brought Bankman-Fried's arrest at his Bahamas apartment, and the U.S. government charged him with 8 counts of wire fraud, conspiracy to commit wire fraud, securities fraud, commodities fraud, and money laundering. Maximum sentence, 110 years. December 19th, 2022 changed the dynamic entirely when Caroline Ellison pleaded guilty to fraud charges and Gary Wang pleaded guilty to fraud charges, with both agreeing to cooperate with federal prosecutors. This was the critical development. His co-conspirators were now government witnesses. October 2023 brought the trial to the U.S. District Court for the Southern District of New York, and the prosecution's case was devastating. Caroline Ellison testified for 3 days, describing in detail how Bankman-Fried directed the fraud, demanded falsified balance sheets, and knew about the $8 billion hole months before collapse. Sam Bankman-Fried built a $32 billion company in 3 years by creating a legitimate-looking exchange, securing blue-chip venture backing, buying mainstream credibility through celebrity endorsements, and cultivating an image as an eccentric genius who wanted to save the world. He lost it all in 10 days because the entire structure was built on stolen customer deposits, falsified balance sheets, and a circular financing scheme that depended on nobody asking questions. The largest one-day wealth loss in Bloomberg Billionaires Index history took him from being ranked the 41st richest American to federal prison. From sleeping on beanbags in a $40 million penthouse to trading mackerel packets in the Metropolitan Detention Center. $8 billion in customer funds stolen. At least $1.73 billion from sophisticated venture investors lost. Hundreds of millions in worthless celebrity endorsements. And an entire ecosystem of crypto companies that collapsed in the contagion. And at the center sat a 30-year-old who convinced some of the smartest investors and most famous athletes in the world that he was building the future, when he was really just running one of the largest frauds in American financial history. That's how Sam Bankman-Fried lost $30 billion and took FTX with him.